There's a threshold in sovereign debt dynamics that economic historians call the point of monetary exhaustion. It's not a metaphor. It's a measurable phenomenon that occurs when a nation's debt service costs begin consuming more capital than its productive economy can generate. When that threshold is crossed, a specific demographic gets destroyed with near-perfect consistency. Not the wealthy, not the destitute, the middle class. The 127 million Americans who hold their net worth primarily in currency-based instruments, savings accounts, money market funds, treasury bonds, fixed annuities, dollar-denominated retirement accounts. This isn't speculation about what might happen. This is documentation of what always happens when monetary exhaustion reaches critical mass. And the United States crossed that threshold in the fourth quarter of 2024. What you're about to see is the mechanism. Let's establish the framework. Every fiat currency system operates within what we can call a liquidity tolerance range. Think of it as the gap between total debt obligations and the productive capacity available to service those obligations. When that gap is narrow, the system remains stable. Markets function normally, currency holds value, credit flows efficiently. But as debt accumulates faster than productive output, that gap widens. The system begins requiring increasing amounts of new currency creation just to prevent collapse. This is where most analysis stops. What matters isn't the debt level itself. What matters is the rate of change in currency creation required to sustain the system. When that rate exceeds a critical velocity, something irreversible happens. The currency enters what physicists would recognize as a phase transition. Confidence doesn't erode gradually. It collapses suddenly, the way ice doesn't slowly become water at 31.5 degrees. It transforms instantly at 32. The United States is now operating at a currency creation velocity that has never been sustained without triggering that phase transition. Let me show you the mathematics. In 2024, the federal government spent approximately $6 trillion. It collected roughly $4.5 trillion in revenue. That leaves a $1.5 trillion gap. But here's what the official deficit numbers obscure. Interest payments on existing debt consume nearly $1 trillion of that expenditure. So the government had to borrow $1 trillion just to pay interest on money already borrowed. This is the mathematical signature of monetary exhaustion. You're not borrowing to invest in productive capacity. You're not borrowing to build infrastructure that generates future returns. You're borrowing to service past borrowing. This creates what systems theorists call a positive feedback loop. Each cycle of borrowing increases the debt stock. Higher debt stock means higher interest obligations. Higher interest obligations require more borrowing. The loop accelerates automatically. Now factor in that interest rates have risen from near zero in 2021 to over 4% by 2024. Every percentage point increase adds roughly $360 billion in annual interest costs to the existing debt stock. The Federal Reserve cannot lower rates without reigniting inflation. They cannot raise rates without making the debt mathematically unpayable. They're trapped in what game theorists would recognize as a zugzwang position. Every available move worsens the position. Here's where it connects to those 127 million Americans. The wealth of the middle class in the United States is overwhelmingly concentrated in three asset categories: residential real estate, retirement accounts, cash and cash equivalents. All three are fundamentally denominated in dollars. All three depend on the dollar maintaining stable purchasing power. When monetary exhaustion triggers the currency phase transition, these assets don't decline gradually. They collapse in real terms almost instantaneously. This isn't theory. We can observe the exact mechanism by examining Britain's transition out of reserve currency status between 1945 and 1976. The pattern is instructive. In 1945, Britain emerged from World War II as the world's largest debtor nation. The pound sterling remained the global reserve currency, but the debt burden was catastrophic. British debt to GDP exceeded 250%. For the next 3 decades, Britain experienced what economists politely call managed decline. In reality, it was systematic wealth destruction of the British middle class. The mechanism worked like this. Government debt service consumed increasingly large portions of economic output. To prevent default, the Bank of England maintained negative real interest rates. Savers lost purchasing power year after year. Simultaneously, inflation averaged 7% annually from 1945 to 1976. The pound lost 90% of its purchasing power over that period. Here's the critical part. The decline wasn't smooth. It occurred in sharp devaluation events. 1949, a 30% devaluation against the dollar. 1967, another 14% overnight. Each devaluation destroyed a chunk of middle-class wealth instantaneously. Families that had saved for decades watched their purchasing power evaporate in single policy decisions. By 1976, Britain went to the International Monetary Fund for an emergency loan. The pound lost reserve currency status permanently. The British middle class never recovered the relative economic position it held in 1945. Not in absolute terms. The statistical wealth is still there in nominal terms. But the purchasing power, the economic security, the ability to maintain generational prosperity, it was gone. Transferred to those who held assets outside the currency system. Now observe the same pattern in a compressed time frame. Argentina between 1998 and 2002. Argentina entered 1998 with a currency board that pegged the peso 1-to-1 with the US dollar. The middle class held substantial savings in peso-denominated bank accounts and government bonds. They believed the peg made their savings equivalent to dollars. The government debt burden had been growing throughout the 1990s, but everyone assumed the dollar peg provided absolute security. By 2001, debt service was consuming 40% of government revenue, mathematically unsustainable. In December 2001, the government froze bank accounts. Citizens couldn't withdraw their own money. In January 2002, the peso peg was abandoned. The currency devalued 75% within weeks. Overnight, middle-class savings lost 3/4 of their value. But it didn't stop there. Over the next year, the peso lost another 50%. Bank accounts that held 100,000 pesos, supposedly equivalent to $100,000, could now purchase what $2,500 could buy. A 97.5% destruction of purchasing power in 14 months. The Argentine middle class was functionally eliminated. Professionals fled the country. Doctors worked as taxi drivers. Engineers emigrated to Spain. The wealth didn't disappear. It transferred to those who had converted pesos to dollars or hard assets before the crisis. To those who understood that currency pegs backed by unsustainable debt are political promises, not economic guarantees. The United States operates under different mechanics, but identical mathematics. There's no currency peg to break. The dollar floats freely. But that doesn't provide protection. It provides a different transmission mechanism for the same outcome. Instead of sudden devaluation against a foreign currency, the destruction occurs through sustained inflation that outpaces nominal wage growth. Real purchasing power declines, while official statistics obscure the velocity of decline. Consider the position of a typical American household in the middle quintile of wealth distribution. Median household net worth is approximately $200,000. Roughly 70% of that is home equity. 20% is in retirement accounts, mostly 401ks and IRAs holding index funds. 10% is cash, savings, and checking accounts. That household depends entirely on dollar stability. If inflation runs at 6% annually, while their wages increase 3%, they lose 3% of purchasing power every year. Over a decade, that's a 26% real wealth destruction. But that assumes linear progression. It assumes the government can maintain controlled inflation at 6%. History suggests that once monetary exhaustion crosses the critical threshold, inflation doesn't remain controlled. It accelerates. Here's the mechanism that creates acceleration. The United States benefits from reserve currency status. Approximately $12 trillion circulate outside U.S. borders, held by foreign central banks, corporations, and individuals for international trade settlement. This creates artificial demand for dollars far beyond domestic economic activity. That demand has allowed the Federal Reserve to expand the money supply from $4 trillion in 2008 to $8.5 trillion by 2024 without triggering immediate hyperinflation. The excess dollars get absorbed by global demand. But global reserve currency status is not a permanent feature. It's a privilege that continues only as long as foreign holders believe the dollar will maintain value. Once confidence begins eroding, those 12 trillion offshore dollars don't just sit there. They start flowing back into the U.S. economy. Foreign central banks reduce treasury holdings. International corporations shift reserves into other currencies. Sovereign wealth funds diversify away from dollar concentration. This creates a double impact. First, reduced foreign demand for treasuries means higher interest rates to attract buyers. Higher rates make debt service more expensive. Second, dollars returning to the U.S. economy increase the domestic money supply. More dollars chasing the same goods means higher prices. Inflation accelerates. The Fed faces the impossible choice: raise rates to combat inflation, which makes the debt unpayable, or keep rates low, which allows inflation to spiral. Either path destroys middle-class dollar-denominated wealth. We can see this process beginning in real-time data. In 2023, foreign holdings of U.S. Treasuries declined by $300 billion. In 2024, they declined by another $270 billion. That's a $570 billion reduction in 2 years. It's not panic selling, it's systematic rebalancing. Exactly what happened with sterling in the 1960s before the final collapse. Exactly what happened with the Dutch guilder in the 1780s. The smart money always leaves before the general public recognizes the problem. And when the smart money leaves, it doesn't return. China's central bank held over $1 trillion in U.S. Treasuries in 2013. By 2024, that figure dropped below $700 billion. Japan, the largest foreign holder, has been slowly reducing positions since 2022. Saudi Arabia is diversifying reserves into euros and yuan. These aren't temporary tactical adjustments. These are strategic shifts in reserve allocation. And they're accelerating. The implications for those 127 million Americans become clear when you model the endgame scenarios. Scenario 1, the high inflation outcome. The Fed maintains low rates to keep the government solvent. Inflation runs between 8 and 12% annually for a sustained period. Housing prices nominally increase, but adjusted for inflation, real home values decline. More critically, the ability to service mortgages becomes strained as property taxes and insurance costs rise faster than incomes. Retirement accounts show positive nominal returns, but negative real returns. A 401k balance might grow from $500,000 to $600,000 over 5 years, while inflation makes that $600,000 purchase what $400,000 purchased before. Real wealth destruction occurs behind nominal growth. Wages lag inflation by 3 to 4 percentage points consistently. The middle-class standard of living declines 20 to 30% over a decade. Not through dramatic crisis, but through grinding erosion that official statistics classify as moderate inflation. Scenario 2, the deflationary collapse outcome. The Fed raises rates aggressively to maintain dollar credibility. Interest rates hit 7 to 8%. Government debt service becomes unsustainable at those rates. Politicians face a choice between defaulting on obligations or implementing draconian spending cuts. Either choice triggers recession. Asset prices collapse. Housing values drop 30 to 40% as mortgage rates make homes unaffordable. Retirement accounts decline as stock markets crash. Unemployment spikes above 10%. Banks fail as loan defaults cascade through the system. This scenario destroys middle-class wealth through asset price collapse rather than currency depreciation. The mechanism differs, but the outcome remains identical. Wealth concentrated in dollar-denominated assets evaporates. Scenario 3, and this is what historical precedent suggests is most likely, a hybrid outcome. Initial high inflation followed by deflationary collapse. The system attempts to inflate away the debt burden. Inflation runs high for 3 to 5 years. This destroys the real value of savings and fixed income instruments. Then, as inflation becomes uncontrollable and threatens hyperinflation, the Fed is forced into emergency rate increases. This triggers the deflationary collapse. Asset prices crash after being inflated. The middle class gets destroyed twice. First through inflation eroding purchasing power, then through deflation destroying nominal asset values. Britain experienced exactly this pattern from 1973 to 1981. High inflation destroyed savings. Then aggressive rate increases to stop inflation triggered a severe recession that crashed asset prices. The British middle class lost wealth in both directions. Now consider who benefits from these transitions. In every historical example of monetary exhaustion and currency crisis, wealth concentrates dramatically. Not because the wealthy are smarter or work harder, because their wealth is structured differently. The wealthy hold productive assets, operating businesses, commercial real estate, resource extraction rights, international equities, commodities, gold. These assets maintain value through currency transitions because their worth derives from productive capacity, not currency denomination. When the Argentine peso collapsed, owners of agricultural land still owned agricultural land. When the British pound was devalued, owners of manufacturing facilities still owned manufacturing facilities. The assets themselves didn't change. Their value in the new currency regime adjusted, but the productive capacity remained. Middle-class wealth holds no such protection. A savings account is a claim on currency. When currency loses value, the claim becomes worthless. A 401k holding index funds is exposed to equity price collapse during deflationary crisis. A house is leveraged, meaning small value declines wipe out equity, while the mortgage obligation remains constant. This creates the wealth transfer mechanism. As monetary exhaustion progresses, those who understand the pattern move assets out of currency-denominated instruments. They buy productive businesses. They acquire land. They purchase commodities. They diversify internationally. When the crisis hits, their wealth is protected or even enhanced. Simultaneously, the middle class, which overwhelmingly keeps wealth in bank accounts, retirement funds, and home equity, loses 30 to 60% of real purchasing power. That wealth doesn't disappear, it transfers. The productive assets owned by the wealthy become more valuable relative to currency. They can purchase middle-class assets at distressed prices. Homes sold in desperation, businesses bankrupted by lack of credit. This happened in Britain. This happened in Argentina. This happened in every historical example of monetary exhaustion. The pattern is absolute. Here's what makes the current U.S. situation particularly acute. The middle class represents approximately 40% of the population, roughly 130 million people. Of those, about 127 million hold the majority of their wealth in vulnerable categories. Why are 3 million excluded from that calculation? Because approximately 3 million households in the middle-income quintile have already diversified significantly into protected asset classes. They hold minimal cash. They own businesses. They've invested in commodities. They've structured for resilience. The remaining 127 million remain fully exposed. They're not exposed because they're ignorant. They're exposed because the entire financial system is structured to funnel middle-class savings into currency-denominated instruments. Employer retirement plans default to target date funds holding treasury bonds. Banks offer savings accounts with interest rates below inflation. Financial advisors recommend balanced portfolios of stocks and bonds, both denominated in dollars. The system is designed to concentrate middle-class wealth in exactly the instruments that get destroyed during monetary exhaustion. And here's the timing consideration that makes this urgent rather than theoretical. The velocity of required currency creation is accelerating. In 2020, the Fed expanded the monetary base by $3 trillion in a single year. That was unprecedented. The justification was pandemic emergency response, but the expansion never reversed. The monetary base remained elevated. Then 2023 required another $1 trillion in expansion. 2024 another $1 trillion. Each year requires more currency creation just to prevent immediate collapse. This is the signature of approaching phase transition. The gap between debt obligations and productive capacity is widening so rapidly that exponentially increasing currency creation is required to bridge it. When currency creation reaches a critical velocity, the phase transition occurs suddenly. Confidence breaks. Foreign holders dump dollar assets. Inflation spikes. The Fed loses control. The timeline from that point to full crisis is measured in months, not years. Britain's final sterling crisis in 1976 took 6 months from the point confidence broke to IMF intervention. Argentina's peso crisis took 3 months from banking freeze to currency collapse. These transitions don't unfold gradually. So what does protection look like in practical terms? First, recognize that this is not about market timing. You cannot predict whether the transition happens in 2026 or 2029. You can only recognize that the trajectory is mathematically certain. Protection means restructuring away from currency-denominated vulnerability regardless of timing. Second, reduce exposure to dollar-denominated promises. Long-duration treasury bonds are particularly vulnerable. They promise fixed dollar payments decades in the future when those dollars may have fractional current purchasing power. Money market funds appear safe but represent pure currency exposure. Fixed annuities are promises to pay dollars in the future, all vulnerable. Third, increase allocation to productive assets with intrinsic value, not speculation, not assets whose value derives purely from expected price appreciation, assets that produce value independent of currency. Operating businesses that generate revenue from real economic activity, agricultural land that produces food, energy infrastructure. These maintain value because they create utility regardless of currency denomination. Fourth, consider international diversification not as speculation on foreign currency appreciation, but as political risk distribution. Having assets in multiple jurisdictions means not being entirely dependent on U.S. policy decisions. Fifth, maintain liquidity in the short term. The transition from monetary exhaustion to crisis often includes a deflationary shock period where cash becomes temporarily valuable as asset prices collapse. Having accessible capital during that window allows purchasing assets at distressed valuations. The 127 million Americans facing wealth destruction aren't facing it because of moral failure. They're facing it because they're operating under a mental model that assumes currency stability is permanent. That model is wrong. No fiat currency in history has maintained stable value for more than 100 years. The dollar has been a pure fiat currency, with no commodity backing since 1971. That's 54 years. The average lifespan of historical fiat currencies is 73 years before collapse or replacement. We're approaching the historical limit. The assumption of permanence is the assumption every middle class made before monetary exhaustion destroyed them. The British middle class in 1945 assumed sterling was permanent. The Argentine middle class in 2000 assumed peso stability was guaranteed. The German middle class in 1922 assumed the paper mark would recover. They were all wrong. The currency phase transition destroyed their wealth, regardless of their assumptions. What's different this time is scale. Britain's middle class was tens of millions. Argentina's was millions. The United States middle class is over 100 million people. The wealth concentration event that follows U.S. monetary exhaustion will be the largest in human history. Trillions of dollars in purchasing power transferring from broad middle-class holdings into concentrated wealthy positions over a compressed time frame. And it will happen exactly the way it has always happened. Not through conspiracy, not through deliberate malicious policy, through the mathematical mechanics of monetary exhaustion reaching critical mass. The government is not trying to destroy middle-class wealth. The government is trying desperately to prevent collapse, but once debt service consumes more capital than the productive economy generates, once currency creation velocity exceeds sustainable limits, control is lost. The phase transition occurs independent of policy intentions. The mathematics override the politics. This is the framework for understanding what comes next, not 4 stages, not historical cycles. A systems analysis of monetary exhaustion reaching critical mass. The United States has crossed the threshold where debt service costs exceed sustainable limits. Currency creation velocity is accelerating to maintain system function. Foreign confidence is eroding as demonstrated by capital outflows. The middle class remains almost entirely positioned in vulnerable assets. The phase transition is approaching. The timeline is unknown, but the direction is mathematically certain. 127 million Americans hold their wealth in instruments that cannot survive what's coming. The transfer will be massive. The outcome is predetermined by mathematics that don't negotiate. The only variable is individual positioning before the transition occurs. Understanding the mechanism is not sufficient. Action based on that understanding is what determines which side of the transfer you occupy when the mathematics run their course.